probably wouldn't have any time to say anything. So this is actually kind of embarrassing, but I didn't prepare anything. This is actually the only slide I have here. Maybe we could just go to questions. No, I do have something. And you might have noticed that both Chris and Charlene opened up with a joke, but I'm going to save mine to the end when I give my forecast. That's my joke. All right? We've heard Chris and Charlene go through a lot of this, and really I'm going to do less of a forecast and more of an implication of what the long-run impact is going to be of what we've done to attempt to get out of this recession. This is just kind of giving us a sense of how we got into this, and I'll make a few comments. I'm not going to go through everything here, but one of the concerns that we had, of course, was a lack of domestic saving, and Charlene pointed out that we've had huge debt that we've taken on at the household level and, of course, at the federal level also. The Fed back in 2004 was accused of making money too cheap. The Fed funds rate was 2% at that time. The inflation rate was about 2.5%, so real interest rates were negative. Money was practically free. Now the Fed funds rate is very low again, but inflation is negative now, so the real interest rate pumps up a little bit. So we don't have quite as loose a money as we had maybe in 2004, but nonetheless, money's fairly loose, and I'll talk about that. This was just some reference points on a recession. I would say, on the first one up there, we say the recession's been going on 16 months, but actually in the second quarter of 2008, because of the tax rebate program that we had positive growth, low positive growth in that year. If we take that away, we're really into our sixth, and it probably will come out of it in the third quarter, but 6 full quarters, 18 months, maybe pushing on 20 months of a downturn in the economy. This has been the longest and the most severe downturn, not in terms of unemployment yet, that we've had since World War II. So what happened in all of that then is that the Fed kind of rides to the rescue, and both Charlie and Chris have talked about this. The Federal Reserve, which is separate from the Treasury, okay? The Treasury sells bonds to buy assets, and the Fed does what we all wish we could do. They print money to buy assets, okay? Because when they pick up an asset, they issue more liabilities, and money is the Fed liability. And so the Fed is buying assets by increasing the monetary base. The Treasury is buying a wide range of assets by selling bonds. We had the Cash for Clunkers program, which was successful, but that's kind of moved on now, and all of the things that Charlene talked about. And so one of the things that did was that increased a large deficit. Then we're fighting a war on two fronts. We had a large deficit, and now we haven't passed it yet, but we're talking about health care, and that could cause the deficit to grow even more. This is the Obama stimulus plan that has not completely been brought into focus yet, but here are some of the areas. Tax relief, that was people getting the tax rebate checks, and some tax credits and so forth that occurred in 2008, $288 billion, $144 billion for state and local fiscal relief. That was having those shovel-ready projects ready to go. I saw a small piece in the paper, I don't know, a month or so ago, that Purdue was going to get $350,000 to build a heliport. I just saw that once. I haven't seen anything since then, but I'm thinking, why are they giving us a heliport without giving us a helicopter too? Come on, if you're gonna have a program, let's follow through on it and make it work. And so we've got a total of $780 billion worth of spending. Now we've already got a deficit because of the two wars, and then we're going to tack on $780 billion. And then if we have health care, it's going to grow even more. But here's kind of, are we climbing out of it? Output's predicted to rise through 2010, 2 to 3%. Unemployment is expected to increase, like Charlene says. We've got this big backlog, and the other thing is this. Even if you have positive growth in the economy, you don't have a recession because you've got positive growth, you can still have unemployment rising because you've got new people entering the labor force all the time, and unless you have about 2 to 2.5% real growth per year, you're not growing enough to absorb the new entrants into the labor force. If you keep growing at 1% per year, unemployment's just going to keep on rising because you got new people coming into the labor force and you're not generating enough jobs to absorb them, and that's why we think unemployment's going to go up above 10%. And the Fed has said a couple of times that they like housing prospects. I don't. Of course, if I'm so smart, how come I'm not in D.C. and instead I'm schlepping over here on a Tuesday afternoon for a buffet dinner for compensation? But I don't think our housing projects are all that great overall. So here's what we've got. We've got this giant deficit that we're going to have. How are we going to pay for this? We're going to do all of this spending. Let's talk about how we're going to pay for this spending. We could raise taxes, but we really haven't talked about doing that yet. As a matter of fact, 35% of the stimulus package was a tax cut. We talked about maybe raising taxes on people earning over $250,000 a year. That has not come through yet. So if we're going to do all of this spending and we're not going to tax finance it, then we're going to deficit finance it. The deficit is projected to be $1.6 trillion for 2009 by the Congressional Budget Office. The White House says $1.4 trillion. The CBO is a little bit higher, and they have a better track record than the White House, regardless of whether it's Democrat or Republican. I'm not doing some political screed here, okay? The CBO is always kind of a more realistic approach. So $1.6 trillion for 2009. That is 11 to 12% of gross domestic product. The last time unemployment was this high was 1983. As I look around this room, I think a number of you may remember that, not insulting anyone, okay, when unemployment was above 10%. The deficit as a percentage of gross domestic product then was 6%. So we've got the same unemployment rate as we did then, and yet we got a deficit to GDP ratio that is double what it was at that time period. We weren't fighting a war at that time, and we didn't have quite the growth in the stimulus package. So that's why I said I wanted to talk about implications as opposed to a forecast in a sense, and what are the implications for that? Well, we don't have time to talk about where the money is going to come from. I have a concern down here at the bottom that if we finance that deficit by the Fed buying the debt, then that's going to lead to more inflation in the economy. I think there are a lot of people concerned about inflation. That's why gold's above $1,000 an ounce. It's not just here we're concerned about inflation. Angela Merkel last summer chastised both the ECB and the Fed for monetizing a lot of the debt that's out there. But the impact is a higher debt to GDP ratio, deficit to GDP ratio, and interest expense ratio. And let's look at this. This is the debt, the stock of debt that we currently have that's running, I don't know, $10.5 trillion a year or so. What's $1 trillion among friends? It's somewhere in that $10 to $11 trillion range. As a percent of gross domestic products, it is as high as it's been since we were coming out of World War II. At the end of World War II, the debt to GDP ratio was 120%. We deficit financed the fighting of World War II, and so the debt to GDP ratio is as high as it has been since we've come down out of World War II. And the reason why that's happening is because we've had fairly high